Good morning. I'd like to call the Pension Committee meeting to order, and I'm going to turn it over to the Alesco advisors, Tim and Jim.
Good morning, everyone. Nice to see all of you. Hopefully everyone is doing well. Just for the benefit of those who are dialed in online, am I able to share the screen? Oh, I am. Am I able to? I think I am.
You should be able to.
You should.
That's fine. Yeah, okay. Let's see if I can share this with you. I think there it is. Can everybody see that?
Yep.
Okay?
Yes.
Yep.
Excellent. Okay. So I'll start off. I know we have a short amount of time, and Jim has some comments to make too, but I want to start off reviewing the portfolio first for the non-salary plan. But just as a quick recap, the equity markets ended the third quarter on a very positive note. We continue to have a very strong recovery coming out of the original COVID pandemic back in the spring. And the stock market has continued to move higher based on the idea. The stock market, as you know, is a forward-looking mechanism looking ahead to next year, where the market is anticipating better economic news and stronger corporate profits. The S&P 500 is up well over 50% from the March 23rd low. So we've continued with, obviously lots of concern about people's health, about the strength of the economy, employment, everything. The market has taken an optimistic view that certainly next year could look very much better than it has this year. That being said, I'll start reviewing the overall portfolio allocation for the non-salaried DB plan. You can see the equity allocation at 66%, right in the middle of the range for equities. In the green pie is real return assets comprised of inflation-protected securities, fixed income. This is our inflation hedging part of the fixed income portfolio, particularly unexpected inflation that might occur in the economy to help protect for that risk. And then the fixed income portfolio right in the middle of the range for the investment policy at 25.6%. And a little bit of cash to fund beneficiary payments at 1.7%. Equity allocation, we have been over the quarter very consistent in our allocations, not making particular changes. We had, as we discussed with you earlier in the spring, a number of changes that we made, really portfolio readjustments in the spring, but the third quarter was, from our perspective, a normal quarter in terms of portfolio transitions. It was very quiet, being consistent with the allocation. Approximately just over around 55% of the portfolio is large cap holdings, a little bit of value exposure in that, and then we push assets down the capitalization spectrum for the long-term benefits of that from a return perspective, about 17%. Equity allocation to the international space, about 30%, 29% as of the end of September. Fixed income holdings here on page 3 for the non-salary DB plan, very high quality investment grade holdings throughout the fixed income portfolio, keeping it a very stable allocation, not trying to reach for yield here. This is the safe part of the portfolio, and we want to keep it that way. It doesn't really pay from the risk perspective to be chasing for yield, and so we want to keep the fixed income portfolio very high quality. Looking at performance, because we have only a few time frames since our relationship with Centro, which we're thrilled to have, is a very short time frame. We're looking at the third quarter performance, and then the inception, which starts back at the beginning of the year. So for the quarter, you can see it was a return of 4.73%, just under 5%, a gain of 1.4, almost $1.5 million for the value for the pension plan, $32.5 million. And just as a quick update, as we're almost all the way through October, October's been a very good month in terms of the new quarter. We're looking at a gain for the portfolio of about 2.26% for the holdings in the pension plan. Equities are up about 3.64%. So this value of the pension is up to $33.4 million. inception takes you back again to the beginning of the year, through obviously a very tough time in the market, and the portfolio is showing a gain of 4.15%, a gain of almost $1.3 million. As we move to the next page, we'll look very quickly at the allocation of the various asset classes and how they have performed since inception. You can see the quarter equities were up 7%. Again, very nice gain there in terms of the equity market. S&P 500 continues to lead from a performance standpoint versus the other asset classes, with the exception of emerging markets. In the quarter, we see emerging markets doing a little bit better than domestic. That's a couple of things going on there. We've got a strong, the dollar has weakened a little bit, and we've seen some improvement out of China from an economic perspective, which has helped push the emerging markets up a little bit above domestic. But that is not the case for the year-to-date numbers. When we look at that, it's been a decidedly large cap oriented market from the performance of the equity asset classes. And you can see that here, 5.57% versus negative returns for the main asset classes that we have in the portfolio. And that's just reflective of the environment that we've been in from a performance standpoint. So it's a little unusual that you can see that divergence, but given the market that we've been in, it's not completely unheard of. When you look at fixed income on the next line, you see that we have had a very big drop in interest rates this year from a performance perspective, putting fixed income in a very nice position from a gain perspective, 5.66%, pretty much in line with the Barclays aggregate from an asset allocation standpoint. And then we had stable returns, fixed income in the quarter of just over 0.5%. The real return assets showed a very nice recovery in the second quarter, and that's what you're reflected here, this performance of 10.6% in the second quarter coming out of the downturn. So that's been a very nice addition to performance that we've seen here. And then in the quarter, again, as inflation expectations potentially rise, we've seen that the TIPS perform quite nicely from a performance standpoint, and that's where you get the return here in terms of the real return assets overall. Any questions in terms of performance for the salary DB plan before I move on to the additional pension plans?
Approximately, what is the average maturity on the fixed income portion?
The maturity on the, we've got a roughly around 5.7 years in terms of the duration. Did you say maturity or duration?
Maturity.
The maturity. The maturity is going to be a little bit longer. We focus on the duration of the fixed income holdings based on thinking about risk, and we keep it very close to the overall bond market, but we're just a little bit under the bond market at 5.7 from the overall duration.
Yeah, the average maturity is going to be about 8 years in, with the duration that as Tim just referenced. So 8 years would be a pretty good estimate.
Thank you.
Moving on, the next couple of pages here are the holdings. I'll skip over those and start in on the salary plan. Allocation is roughly the same for all the portfolios in terms of the pension plan, in terms of the mix. Equity range, 51 to 71%. You see equities at 65.7%, right in the middle of the range. The TIPS holdings for the real return assets towards the bottom at 6.5%, and then fixed income, middle of the range again, 25.7%, and cash at 2% in the salary plan. Looking at the equity allocation, same as in the non-salary, about 55% in equities, large cap just at 50%, a little bit of value at 4%, down the capitalization spectrum to mid and small in terms of about 17% there, and then international stocks at 29%. Fixed income, same again, most of the assets in the broad bond market, 90%, a little bit in corporate investment grade floating rate, but consistent, again, high quality, keeping the risk on the low side for this part of the pension plan. Looking at performance, we see the third quarter again, 4.7% return for the plan, investment gain of 1.43 million, and the value at the end of the quarter was $31.75 million. And we're seeing a similar gain here in terms of the quarter. From a performance standpoint, we're up about 2.24%, equities at just over 3.5%. So the quarter beginning here through most of the month of October continues to be strong. Performance for the inception, 4.12%, and that beginning of this year, a gain of 1.2%. $1.2 million gain, excuse me. Asset class performance will be the same as you see in the other plan. Equities, 7% return for the quarter. Slight decline for the year, 2.25%, and that, again, narrow performance out of the S&P 500, leading the market to the exclusion of the other asset classes so far this year. Fixed income performance, 6.61%, right in line with the Barclays aggregate for the quarter, and very close to it for the inception, 5.83% return for the Barclays aggregate comparison at 6.79%. You see the similar performance for the real return assets, 2.4% for the quarter, and that 10.61 reflecting the big bounce back in real return assets that we saw in the second quarter. Any questions related to the salary plan?
In the fixed income portion, going back to that for a minute, are they using the perpetual preferreds?
Go ahead, Jim.
I didn't hear the question.
In the fixed income portion, are the ETFs using the perpetual preferreds?
No, these are straight
Fixed income
notes
bonds.
and bonds. There are no preferred stocks in the portfolio at all.
Yeah, thank you.
Yes, and just briefly, just to clarify that a little bit, we've got basically two investments: the Vanguard Total Bond Market Fund, which is a broad exposure to the entire U.S. bond market that includes corporates, treasuries, as well as agencies, all in investment grade, average of A in terms of that particular portfolio. And then we do have some floating rate corporate investment grade bonds just to help keep the duration on the portfolio a little bit below the market. So that's the two holdings that we have, very broadly diversified from a issuer perspective in terms of the mix of those.
The other thing in the equity portion, you got a small cap ETF, and it has the word ultra in front of it. Does that mean it's leveraged?
No.
Okay. Thank you.
This is okay. It is not levered at all. That's referring to the decile in terms of the representative holdings of the small cap. It's a micro cap fund. So they use the word ultra to define micro cap, which is the lowest capitalization spectrum on the equity market.
Thank you.
Finally, just run quickly through the Utica plan, and then I'll hand it off to Jim, who will provide some comments and background related to the overall capital markets. Utica plan allocation, very similar to the other two pension plans. Equity range 51 to 71, again 65.4% for equity holders, right in the middle of the range. Real return assets at 6.6%. Fixed income 25.3, again middle of the range, about 3%, just under 3% for cash. Equities similar to the other two plans. International holdings at 29.6, 50%, just under 50% for large cap. Similar exposure to mid, small, and micro cap. Very diversified equity portfolio. Fixed income the same, broad bond market, and the corporate investment grade floating rate is just under 10%. Utica plan in terms of performance, you'll see again similar performance profile because of similar asset allocation in the quarter, a gain of 4.7%, $407,000 to the value, investment gain $9 million at the end of September. Again, this portfolio has moved up in the month of October, had a gain overall of about 2%, 2.23%, up to $9.2 million. Inception, 4%, when you round it up, $306,000 gain on the Utica plan. Just quickly show you the asset class performance again for the various holdings here. The same as what you've seen for the other two plans. Equities up in the quarter, 7%, a little bit of a decline for the year in that strength in the large cap space. Any questions specifically related to Utica?
No.
All right, I will go through the holdings here and hand it off to Jim, who's got some comments, and told me we'll take the rest of the time and go over the capital markets and answer any additional questions. Jim?
Yeah, I just want to do a time check here. Do we have 10 minutes or just 5?
You can have 10. Yeah, go ahead.
Okay, thank you. So, these are the key things that we'd like to discuss with you. You're seeing over the last 6 months things opening up again. We certainly are having pockets of infection increases that will have, at least on a temporary basis, have negative impact. But generally speaking, global economic activity is picking up. In the United States, it's picking up quite significantly. And as Tim had referenced earlier, that's what the stock market is really focused on, is we're not so much on 2020, but where we're going to be in years beyond 2020. And with interest rates as low as they are, with the stock market is a forward-looking mechanism. It discounts future cash flows. Cash flows being profits from companies. Those cash flows are discounted based on prevailing and expected interest rates. The Federal Reserve has made it pretty clear that they're going to keep interest rates low, and through their open market transactions are not just influencing short-term interest rates, but intermediate and longer-term interest rates. And so that's why investors are as excited as they are about corporate earnings in future years. We wanted to also talk a little bit about the very last bullet on this page, where Tim had pointed out that large company stocks have been leading the charge on a year-to-date basis, and that's actually been the case for the last few years, compared to mid-cap stocks and small-cap stocks, and also compared to international stocks, so domestic large versus international. And that's something that it won't go on forever. We're going to talk a little bit about that as it relates to how your portfolio is positioned. The next slide, Tim, please. And go beyond that, please. I'm not going to spend too much time talking about the virus. You're all familiar with what's happening. The key things here as it relates to an economic recovery will be getting therapeutics out, widely distributed, and having vaccines that are available. There's been a lot of good news on that front, as you know, but we're still quite a ways away from having the vaccines and therapeutics fully approved, and then they need to be available, and 2 and 3 people need to use them. The vaccine, people have to get vaccinated, and we just don't know how long that's going to take. Next slide, please. So probably the most common question we get is about the election. What's going to happen? It's been a topsy-turvy campaign cycle, back and forth, a lot of discussion, a lot of negative comments made about the other guy on both sides of the aisle. So what we show here is that really it's hard to know what's going to happen to the market based on what party the person is in the White House. So history has shown that Democratic presidents have actually had a higher average rate of return in the stock market. The market's been higher while we've had a Democrat in the White House than a Republican. Some people are surprised by that. But we'll also point out it's not a particularly large sample size. It goes back to the Truman administration. Probably the biggest takeaway is really the lower right-hand part of this slide that shows that the market has done very well when there's been a blend of parties in control, both where there's been either a Democrat in the White House and have at least one of the houses of Congress controlled by Republicans, or vice versa. So the most common thing also that we're hearing is the standard comment by just about everybody is they're really worried about the other guy winning. Whoever they're not rooting for, they're really worried that that person's going to win. And so our guess is that there's quite a bit of money on the sidelines as it relates to investing. And once we have certainty in terms of who is going to be the president and who is controlling the Senate, there'll be certainty with that, and Wall Street will be more comfortable. We think we'll see more money move into the markets by investors. Next slide, please, Tim. Go to the next one, too, please. So just real quickly here, you all know what happened, how difficult the end of the first quarter and the second quarter of this calendar year were. What I think is important to point out and remind you is that this group made a very good move. We had suggested to you that you increase your equity allocation in the late winter, springtime, right when the markets were at their lows, and you move forward with that. You move forward with that because it was recognized that it was the right thing to do longer term. And that's helped you a lot because those additional monies got invested in the stock market pretty much at the market lows, and the economy's nadir. And now we see this very nice recovery that's taking place in the economy, that we fully recognize there's quite a long ways to go before we get back to where we were before the pandemic. But that asset allocation adjustment, made for all the right reasons, based on long-term considerations for the pension, has served you very well so far. We're seeing a lot of positive news out there. If you look at the bottom part of page 27, you'll see consumer spending has recovered. It's not back to where it was, but it's recovered quite considerably. And we expect you to consider, we expect to see a continuation of that recovery, not just in consumer spending, but also the psychological aspects of consumption, which would be consumer expectations and consumer confidence. So all three of those characteristics we think are favorable. Next, please, Tim. So if we look at the manufacturing sector and the services sector of our economy, the ISM, which is the Institute for Supply Management, we look at the survey data, and it's positive for both manufacturing and services. This is on a national basis. This is a great leading economic indicator, and it suggests that we're going to see continued economic expansion. Unemployment has dropped quite considerably, as you all know. We point out in the bottom part of this slide, there clearly are sectors of the economy where employment is not likely to come back quickly. And the issue there primarily, as we mentioned in our last quarterly report, is that the people in those sectors, for the most part, are not highly educated and therefore are going to have a harder time being redeployed into other parts of the economy that may be recovering. So it is our expectation that we're going to have a higher level of unemployment, not as high as it is right now, but it's not going to drop back down to the 3.5% range, or even below 5%, probably for quite some time. It's going to take much longer. Or maybe a better way of saying it, it's going to take, we're going to need to see a dramatic recovery in the leisure and hospitality area, in the travel areas, those areas that have been hit the hardest. Next, please, Tim. Housing markets have recovered across the nation. I'm sure you've seen it in Syracuse. It's been the case in all of upstate New York, and as I said, on a national basis. One of the key things that they're there's a change of mindset with a lot of people who live in larger metropolitan areas, deciding that they are enjoying the virtual work style of participating in their roles, and a lot of businesses are allowing more employees to do that. So there is a big demand for housing. We saw 6 million units in August. It's a tremendous number. But the net result of that is because everything is being purchased quickly and at higher prices. One of the consequences is there's not much in the way of inventory. So existing home inventories for sale are low. Consequently, people are building more homes, and so home builder sentiment is very high. It's the highest on record going back to 1985. This is extremely important for economic activity because there are so many ancillary purchases that are associated when people move to a new home, whether they're buying a pre-existing home or building a new one. Next, please. We talked about the Federal Reserve. I mentioned interest rates are likely to be lower for longer. But also the other key thing, and perhaps one of the greatest announcements ever made by the Federal Reserve, hasn't gotten a huge amount of press, is moving away from a target for inflation. The long-term target has been 2%, and focusing more on an average level of inflation over a period of time. This is hugely important as it relates to corporate profitability. The corporate profits are likely to improve in a period of higher inflation because businesses can raise the prices of their goods being sold or services provided faster than their costs go up. So this is also a positive sign as it relates to future economic activity as well as corporate profitability. And then lastly, Europe, actually I think there's one more slide after this, but just quickly, Europe hasn't seen the decline that we have seen, nor has it, but it's not having as big a recovery. But on a net basis, it's been much more stable. And the primary reason for that is they've had a far higher level of fiscal intervention by their governments. Next slide, Tim. So I talked about positioning in your portfolio and how we're very encouraged how things are shaping up as it relates to future returns. Some of it is certainly from a macroeconomic standpoint, but also within the portfolio. As Tim pointed out, certain parts of the stock market haven't done as well as the S&P 500, smaller capitalization stocks as well as value stocks specifically. So what you see here is over the long haul on page 33, I won't go through all the data here, but if you look at the right-hand part of the slide, small cap stocks on a rolling 10-year basis outperform large cap stocks 70% of the time. And when they outperform by an average amount of 4.5% per year, versus large cap stocks, they only do better about 30% of the time and outperform by 1.7%. So there's a lot of reason to have a skewing towards smaller capitalization stocks, particularly when we're talking about a pension fund or pension funds, where we have this long-term investment mindset. Next slide. Thanks, Tim. And then this is the same exact thing as value versus growth. Large cap growth stocks have been all the rage, particularly in recent last few years, and particularly this year, where there's a tremendous concentration of the return in the large growth stocks has been in just 5 or 6 names, 5 or 6 companies. And so here you can see that value outperforming 81% of the time on a rolling 10-year basis, and by a whopping 5.5% annualized, versus growth when it outperforms far less frequently and by about half as much. So those are the comments we have for today. I know I went 3 minutes over. Thank you for that. I just want to see if there are any questions.
No, that was a good report. This is Nick Lano. Thank you very much. That was a very good report.
Yeah, thank you.
Our pleasure. Thank you. Are we hop off now then?
Yes,
Yep,
yes,
we're all
you
set.
have.
Thanks, guys.
Thank
Thank you very much. Have a good day.
You too.
Committee meeting, no action was taken at this point. We will come back at 10 o'clock.
That's still red, Chris. Does that mean that that's not on?
Throw me off forever. I remember when this EJ was like a junior high school kid. You know?
He still is.
That tells you how.
It's
I
the audio
I remember
works.
you hanging on the bowling alley. Look at that baby face. He still is.
Yeah, I used to love bowling league.
His father would pick him up and bring him to bowling.
Mr. Chairman, you're good to go.
Okay, folks, welcome to the October meeting. Note, there's a quorum present. Our next meeting date is November 20th. Oh, I'm sorry, we're gonna move into audit and finance. We had such a long break there. I don't have my A game on. And plus Linda did such a great job with the audit and finance committee work. I don't want to forget about her. So, into audit and finance, once again, I wanna thank Linda for her work and putting it together. I think she did a phenomenal job. We didn't miss a beat, so thank you. So Linda, let's start out a little bit with the financial reports.
I'm going to start with the consolidated statement of net position. Nothing remarkable as of 9/30, pretty consistent with prior months. We do have sufficient cash at 4.7. That's mainly due to the cash we received from STOA payment in August. The quick ratio as of 9/30 is 1.99. It's a decrease from March 31st of about 2.1. That's mainly due to the receivables that we had as of March 31st. They were higher due to fiscal year end, and that's pretty consistent every year. The statement of revenues and expenses, as of 9/30, we have a gain of $347,000. This is about $1 million decrease from last month. The operating revenues are $5.7 million under budget at this time. If you wanted me to comment on the operating revenues,
Yeah, please.
mainly, the decreases are mainly due to COVID-19. As you can see in the report, regular line revenues, they're under budget about $2.9 million. And that's mainly due to, we stopped collecting fares in March and began again in June 15th. The other decreases are from the fare box revenues being under budget due to the decrease in ridership, pass sales, decreases in call bus due to ridership decreases, and the biggest one is also the New York State Fair Park and Ride revenues. Special line, also due to COVID-19, we have all the reductions due to the contract amendments due to COVID-19, and small decreases in advertising and other revenues, also due to COVID-19 because of rent decreases and parking lot revenues.
So Linda, cash flow is
That's
okay?
the biggest.
Cash flow is okay?
I'm sorry?
Cash flow is okay?
Yes, cash flow is fine as of right now because we received our STOA in August.
That's all right.
But in the month of October, we have more need for cash, so we're going to be borrowing from the line of credit. I'm sorry, we're going to be drawing on the CARES Act about $1 million, and then we'll probably be borrowing from the insurance reserve.
What's the balance of the CARES Act?
Cash will continue to be something that we have to look into, and we have to balance whether to borrow or to draw from the CARES Act.
Okay, good. Anybody have any questions regarding our financials for that month? No? Okay, I need a motion.
No, I have more.
Oh, you wanna, okay, go ahead, Linda. Go ahead, Linda.
Receivables reports, they are also required quarterly. Not much to comment on, except for we have one receivable we do need to address with the board. Melissa's prepared to talk about that.
Good morning, everybody. We are requesting to write off the normal communications balance of $20,000. This is the remaining balance from the settlement that we entered in with them in 2015 for the total of $75,000. We've collected to date about 73% of that. And with several attempts and assistance from our legal team, we have not been successful with collecting that remaining balance. So with that, we've reviewed this with the executive management team, and it's been determined that this is uncollectible. So we would like to write this balance off
Okay.
with the approval from the board.
Alright, so do we need, I'm gonna need a motion for that, that write-off. So, Linda, why don't you state exactly what it is, and then I'll make that a motion on that piece of it?
That we need board approval to write off the, $20,000 normal receivable.
Okay. As stated, on this, we're gonna keep this separate from the, financials. As Linda's motion was stated, I need a motion on that write-off. Robert, second. Joe, all in favor? Aye. Okay. Okay, continue, Linda.
Okay, the other statement we need board approval for is the, budget impact statement. That's also included in your report. This is as of 9/30/2020. I need board approval for this so that I can load it into the para system, at the end of the month.
Okay.
And the last statements are the supplemental statements. You have your reserves. I added an extra column on this report this month with projections throughout the fiscal year.
Excellent.
We're projecting a zero operating gain. And also you have your mortgage tax statement, another good month. And lastly, the statement of borrowings, both are available at this time for borrowing. And that's it.
Okay.
If there aren't any questions,
No.
that concludes my report.
That's very good. You did a great job. So I wanna start out with a motion for the budget impact statement. Need a motion to accept that? Robert, second. Luella, all in favor? Aye. Great. Now I need a, motion to accept the financial reports, ending September 30th. Robert, second. Luella, all in favor? Aye. Very good. Okay. Nice job. We're gonna move on to,
Mr. Chairman?
Yes,
Well,
sir.
we might wanna consider doing, we had a presentation and they talked about interest rates.
Yep.
And the other day I saw a 5-year certificate deposit trading at .004. We might wanna revisit the interest we're paying on the line of credit. I mean, because
Sure.
interest rates are so low, that might be something we could
Yep.
consider.
Okay. Brian, take a look at that. Okay. EJ, let's talk about, the fleet and facilities piece.
So as a part of our federally required transit asset management plan that the board approved 2 years ago, it is required to have an accountable executive as part of that plan. The current listed executive is the chief operating officer, so we are asking the board to approve that the vice president of fleet and facilities be put in that position as the accountable executive for the transit asset management plan.
It's Jeff. It's Jeff, correct?
Yes.
Okay. Okay, need a motion to, move the COO's, duties over to the, let me see, over to the VP of Fleet and Facilities. Motion for that. Robert, second. Joe, all in favor? Aye. Okay, very good.
Thank you.
Good. Okay, moving into, resolutions. Resolution 1, Services for Employee Assistance Program. Caitlin.
Thank you, Mr. Chairman. Good morning, everyone. This is a resolution for admin services for our Employee Assistance Program. This will be paid for using operating funds. The request for proposal was advertised on August 6th. We sent out 12 proposal packages, 3 of which were minority and women-owned business enterprises, and an additional 26 proposals were requested. On August 27th, we received 1 proposal from our incumbent, Kraus Help People. They held their rates flat at $17.50 per employee for the full 5-year term.
Good.
There is a full waiver for MWBE participation currently pending with Empire State Development on this contract.
But I think it's a
I'm
good,
asking for an award to Crouse Help People.
I think it's a good program, and I'm hoping, that people, Jackie, use that resource. So I need a motion to accept, Kraus Help People for the Employee Assistance Program. A motion? Robert, second. Joe.
moved.
No, second, motion by Tina, seconded by Robert. All in favor? Aye. Okay. Caitlin, once again, you're gonna talk about our Microsoft software licensing upgrade. That's resolution number 23C.
Yes, this purchase will be paid for with federal CARES Act funds for year 1 and operating funds for years 2 and 3. The original software agreement was brought to you for your approval in June. This is an upgrade to that agreement. This will cover additional features to our Microsoft Teams, which will be beneficial to remote working, as well as allow our Exchange server to access the cloud. The full 3-year pricing for this contract or agreement is $48,974. So we are asking the board to authorize payment to Dell for this amount for a 3-year term.
Well, I liked how we used that first year for the CARES Act drawdown, so kudos there. That's good. I need a motion to, for the Microsoft software licensing upgrade with Dell for just under $49,000. Luella, second. Joe, all in favor? Aye. Okay, EJ, you're back up for our resolution 3, number 3D. We need a Bobcat, and we need all the little gadgets that go with that Bobcat.
Yes. This is a resolution to purchase a Toolcat service vehicle for Central of Oneida primarily for snow removal. This is off of the New York State Office of General Services contract with Clark Equipment Company, doing business as Bobcat Company, in the amount of $62,020.23. And this is 100% state dedicated funding.
Good. Okay, I'm sure they'll be happy with that when that snow starts falling. Resolution 3, purchase of Bobcat, Toolcat, and accessories, and a motion to accept that under state pricing, just under, about $62,000. Robert, second. Joe, all in favor? Aye. Okay, we're gonna go to resolutions 4, number 3E.
This is a resolution to purchase a replacement scrubber sweeper for the Syracuse garage. This will be purchased off the Federal General Services Administration contract. The contract is with Tenant Sales and Service Company in the amount of $68,046.02. And it also is 100% state dedicated capital funding.
Okay. Motion to purchase the tenant floor sweeper for Syracuse. Just around $68,000. Tenant sales. Motion. Robert, second. Luella? All in favor? Aye. Okay.
Thank you very much.
Thank you. Resolution 5, lease of the Rome Bus Depot. Yeah, Tara?
Good morning, Mr. Chairman. Good morning, everyone. We are looking to enter into a lease with the City of Rome for the Rome Bus Depot, also known as their hub. We are looking for a 5-year contract. The cost of it will be $1 per year. The contract has 2 5-year renewals on it, and I'm looking to ratify this back to September 1st of this year.
Okay, hopefully we can afford the dollar. I need a motion to ratify this contract. Robert, second. Joe, all in favor? Great negotiating. We might make you counsel. I'm gonna eliminate these guys. Okay, resolution 6. Okay, SUNY Upstate ILOT parking space lease. Tara?
Yes. We are looking to enter into this lease or renew it, if you will. The ILOT houses 267 parking spaces that SUNY leases. Through some negotiating, we were able to get some great numbers. And over the 5-year term of this lease, we are looking at $714,000 ratify this back as well to September 1st of this year.
Okay, so we're gonna ratify the SUNY Upstate ILOT parking space lease. Need a motion for that? Robert, second. Luella, all in favor? Aye. Okay. Linda, is there any other, business from the finance, committee? Linda, any more business? Linda? Any more business from finance committee? Is that it? I think you're on mute.
Sorry, I was muted. No, that concludes the report.
Okay, very good. That concludes our audit and finance committee report.